Hi everyone, I hope you're all doing well. In this video, I'm going to share one of my portfolio. With recent market correction or even crash, considering many growth stocks have down more than 40% so far, many investor portfolio are likely down significantly from the all-time high back in mid-February, including my portfolio. So this is probably not best time to do a portfolio update, but it could be interesting to see the impact of the corrections and some of the lessons learned so far. So we'll discuss briefly about portfolio allocation, diversification, and what are my top 5 best and worst performing stocks, and did I sell any stock at a loss?
All right, so here's my DEGIRO portfolio. The total investment value is around 87,000 euro with 17,000 in return, so that's around 24%. So that's actually down 50% from the all-time high back in mid-February. So I have a lot of stocks here, 45 stocks position in total. I have ETF and a small allocation in crypto as well, just not in this portfolio. So you might ask why I have so many position. Yeah, so if you look at the some of the position here is actually very small, less than $1,000. This is just newer idea, usually new position that I just bought to start following the business, and then as I have more conviction on them, I start adding to them, and that's how I usually grow the allocation in my portfolio. But a different investor has a different style. If I sort this by the largest position, the 13 largest stock here actually make up 65% of the portfolio, so it's not very well scattered. It's not scattered through the different stocks that I have. So there's not much I could use from the Giro here to provide you with some of the insights from this portfolio. So I'll just switch to Walmart, one of the portfolio tracker that I use to track the different portfolio from different stockbrokers that I use. So yeah, back to the total return, as you can see, around mid-February, it was close to 50%, and then it just continued to go down during the correction. It was 14%, 15% profit at some point, and then now it has recovered a bit to around 23%. So looking at the allocation, this is the largest position that I have: Enphase, Microsoft, Mastercard, Stitch Fix, Starbucks, Salesforce, Zynga, which is a mobile gaming company, Crowdstrike, cloud security company, Shopify e-commerce, Arista Network, cloud infrastructure, and a Activision Blizzard is another gaming company, Disney, and ServiceNow. So most of the companies here are large cap stocks, but I have small caps as well. So yeah, and by industry, you can see a majority of them is in technology, but technology are in a lot of industry nowadays, so you can be still somewhat diversified even though most of your investment is in technology area. So there are some other in utilities, healthcare, finance, consumer discretionary, communication, and so on. And as you can see, the different industry here. Yeah, there are a lot of different allocation across the different industry to keep this portfolio a little bit more balanced, not just focus in one sector only. So in terms of geography, 80% of this portfolio is based on US stocks. I have some allocation from stocks from Germany, Singapore, Taiwan, China, Australia, Canada, and so on. So yeah, trying to get more exposure to international market as well. So for dividend, my portfolio is not really focused on dividend, but there are some dividend stocks here as well, like Microsoft, Starbucks, and Activision Blizzard. But the value is not really that big. Okay, so what are the top five best performing stocks that I have? The first one is Stitch Fix. It's a specialty retail providing personal styling for women, men, and children. So it works by sending a customer a fix, which is a personalized clothing based on the user input. And then as you use the service more often, they make use of machine learning to get a better recommendation, and you can try the fix and decided which one you want to buy, and the shipping and return is also free and no subscription is required. So I like the idea of this business, and as you can see here, it is appreciating quite a bit, and then uh, reach a peak to $100 here because of short squeeze, and then it dropped significantly during the correction. I did sell a bit during the correction just to reduce the allocation because it was becoming bigger than what I was comfortable with. Yeah, but still, the total return from this stock is still quite significant for me because I got in around the market crash during the Corona last year. Okay, so the second stocks is Invest Energy. It's one of the best solar stocks in my opinion. It design, develop, manufacture, and sell home energy solution for solar industry in the United States and international market as well. So basically, it offers semiconductor-based microinverter which convert energy at individual solar module and combine it with its proprietary networking and software technologies to provide energy monitoring and control service. So basically, from what I have read, it's one of the best microinverter out there. They also have the largest market share and the significant profit margin as well. So with the president election last year, there are a lot of momentum around solar stocks. So they uh, appreciate quickly to around 220, and the last earning result has been pretty good for Enphase, but more recently there are multiple corrections, and in the last earning result that they have, they reported that they are affected by the chip shortage as well. So it's also causing some of the pressure on the market, on the share price recently. The third company is IDEX Laboratories, ticker symbol IDXX. They provide diagnostic tests and services for small and large animal veterinarians. So they have services that help enhance health and well-being of pets, people, and livestock. And they are a growing and profitable business with exposure to international market as well. So it's a really good company to invest in. So the fourth stock is Crowdstrike. It's a cybersecurity company. It helped some of the largest company from security breaches. So I'm still very bullish on this company because demand for cybersecurity keeps increasing and not going away anytime soon. It's a major concern for companies and government around the world. So no one wants to be featured on the news because they have been hacked successfully. And the pandemic also has accelerated online presence for more and more companies. So there's no reason why this company would grow more and acquire more customer. So the valuation is not really cheap, and there has been a correction. It's down more than 20% from the all-time high in mid-February. I still believe in the potential on this company, and they are going to report earnings soon, so we'll see how they're doing. But the last few quarters, their earning results have been really good, so I have high expectation for them. Okay, so the last stock is Arista Network. It's a company providing networking solution for some of the largest technology company like Microsoft and Facebook. So I haven't added to this position recently because it was trading sideways for some time. And after its last earning on February, it has a really good result and even provide a good growth guidance for the next few quarters, but then it also experienced some of the corrections, but it has recovered since then. But we'll see how they do in their next earning result. Okay, so we have looked at the top 5 best performing stocks, and now let's look at the top 5 worst performing stock in terms of percentage of return. So the 5 stocks are Lemonade, Appian, Neo, Peloton, and Mercado Libre. So if you look at the total return, they are down quite a lot. Lemonade minus 49%, Appian minus 42%, Neo and Peloton is more than 30% and so on. So, but compare that to the total market value of this position, they are relatively smaller compared to the other position that I have. So, although they are down significant, they are not affecting the total portfolio value as much, just because they are newer position that I added over the last few months to my portfolio. So the first stocks is Lemonade. It's an insurance company providing home insurance, pet insurance, life insurance, and so on. So what's unique about them is they try to disrupt the insurance industry by making use of artificial intelligence and behavioral economics in their service. And their customer seems to be happy with Lemonade. Unfortunately for me, I got in at a pretty high price, not exactly at the all-time high, but still, there were multiple corrections on these stocks, and it's now 78, down almost 50% from the price I bought it. It's still a small position for me, and given the market cap is really small, less than $5 billion, the potential, if they are doing well, they could recover significantly from here. So I just plan to keep them and not averaging down at this point, but I'll just see how their business go from here. So the next one is Appian. Is a platform as a service company for building enterprise application. It's a low code platform allowing company who don't want to invest a lot of software development investment, so they can build enterprise application quickly. So similar with Lemonade, I also got in here, not exactly at the all-time high, but still a quite high price. And it is down significantly. But at this point, my position on this stock is quite small. There's not much that point in reallocating them. I still believe that it could recover from here, so I'll just keep them. Yeah, so the third company is NIO. You probably have heard of this company. It's one of the electric vehicle manufacturer from China. So China arguably is the largest EV market, and it's going to be important in the future. That's why I just started a small position on this company. I got in at a pretty high price, around 50. And as with any EV companies out there at the moment, the valuation is quite high, and the correction that has happened in the last few weeks is probably a healthy one. And I averaged down on this position, just not on the zero, because I keep adding a small position, sometimes fractional, which is not supported in the zero. But yeah, exciting for the future once this stock recover. So moving on to the next company, Peloton Interactive provide sport equipment for exercising at home. They have subscription as well, and you probably have heard of the Peloton bike, which is quite expensive, but the user seems to be happy with them. I have concern on how they'll be able to retain the customer with the reopening and more people will be exercising outdoor, but yeah, just keeping it for now, not averaging down, and we'll see how they do in the next earning result. The last stock is Mercado Libre. So among the 5 worst performing stocks that I have. This is the one that I have the most conviction on. So it's a leading e-commerce business in Latin America, but it's so much more than that. It has digital payment Mercado Pago, and it recently expanded into insurance, investment management, and consumer lending as well. So in many parts of Latin America, internet penetration is still less than 70%. So hundreds of millions of people have yet to make their first e-commerce purchase, and that can be in Mercado Libre platform. And I have high conviction on them as well because they dominated the e-commerce market in Mexico, where Amazon and Walmart also operates. So I got in at pretty high price, around 1800 for my first purchase, and the highest it was around 2000, and since then it has been correcting quite a bit. Last price is 1300, and as I have high conviction on these stocks, I buy the dip, just not at the zero, because with the share price more than 1000 already, I prefer to buy fractional shares, um, as we have a long period of dip here. So yeah, very exciting investment, although it's down quite a lot, but I still believe that it will recover in the next few years.
So during the market correction, I did sell stocks of two companies that I no longer believe in. The first one is Enterprise Product Partner. So it's an American midstream natural gas and crude oil pipeline with headquarters in Houston. So I bought it in January 2020, and the reason I bought it is for the high yield and consistent growth of dividend yield. But it's also unfortunate timing, because right after I bought it, we had the oil crisis around March, and at around the same time, we have the coronavirus market crash. So it just continued to go down from there. It has recovered a little bit with the potential reopening. More economic activity will boost the oil price again. However, for long-term investment, I feel like the investment could be reallocated better toward green energy stocks. So I sold it and then reallocated to companies like Enphase and Next Energy, which have been doing better as well. So I thought it was a good decision to make. And the second one is Editas Medicine. It's one of the biotech company doing research and development using the CRISPR gene editing technology, which is a very revolutionary technology. But the problem with Editas Medicine is it could take years before we even see a launch of a product. So a lot could happen in the meantime, and they also recently have leadership change. On the flip side, if they are successful, they could go on develop treatment for rare and otherwise difficult to cure diseases using this gene editing technology, and that could be a very rewarding for very high above average risk tolerance investor. But I decided just to sell anyway, just because the risk is too high for me, and also I'm still new to this industry. I keep exposure to this industry by keeping ETF that in healthcare innovation from iShare. So I'm still following, but not investing in the stock of Editas Medicine directly. Okay, so far we talk about selling stock that you no longer believe in. So how about selling stock to take a secure profit? So as a long-term investor, I prefer not to interrupt the compounding machine, especially if they are still performing well and I don't need the money in the short term. So I prefer to keep investing in the stock market. Looking back though, there might be a situation where you want to take profit if the stock price just continue to go up for no reason, and the fundamental no longer support it because of the hype, for example. So this is something that I'm still figuring out myself. In my opinion, reducing allocation when a stock position becomes too large is always a valid point, but selling just to secure profit, I'm not too sure about that. Just because I have more experience in the past where I sold good performing stocks too early. So anyway, this is all just my opinion. If you have a different take on this, feel free to drop a comment down below. And as usual, this is not a financial advice. Always do your own research before making investment decision, and see you next time.